What's up, guys and gals? I think I have something decent for you guys today. I have been wanting to do this video for a while now, but I haven't had a chance. But thanks to the quarantine, I have fulfilled this promise for myself, and hopefully you guys will find this helpful, okay? So this video is about 3 different ways of trading option. So the number one way is the Wall Street way. The number two is the get or fall out of the money way, and then number three is selling premium for a stable income. I won't go over too in depth with that, but I will go over quickly with it. Okay, so let's go. The Wall Street way. Okay, the Wall Street way is simple yet complicated. The understanding of it is simple, but when you get into the technical part of it is very complicated. They use spread and all that stuff. So basically, they like to buy close to the money option, but they use spread to lower the cost, and that lower the risk. So basically, so for example, let's go to it. So as you can see here, just so this is the strategy: vertical call, vertical port, counter call, counter port. All this stuff you could read it all in a combination of things. Straddle, strangle. So those are some of the things that they use. Okay. So let's go to example. Okay, so before you trade anything, okay, you need to have a thesis. You have to form a thesis, and you have to find out the direction of the stock. Okay, for example, right now, right, this is McDonald. Okay, this is daily chart of McDonald. Okay, so we have been bouncing back from the low here. Okay, and at this point, it's come close to the 20-day moving average. Okay, right now, my thesis is that is gonna, when it meet here, or it will be around here, or at this point I could start in already shorting this position. So we have 3 up day, okay, and we went back up to like maybe 15% in 3 days. So it's a big run up from the bottom, from 125 to 170. But the thing is, McDonald right now, right, if you look at the 3-day chart, 3 minutes chart, right, McDonald only up today, only up 2.5%. Okay, and it's quite weak. This is yesterday close, right, and this is where it goes. So this compared to the S&P. Okay, there's the S&P today is fairly strong. It's up like nearly 6%, and McDonald's only up like 2-something%. So its relative strength is not as strong as an S&P. And right now, if you look at the daily chart of S&P, it's close to the 20-day moving average too. So I'm assuming when it's reached this, it has one more day to go. Tomorrow, they're gonna hopefully pass the virus thing, the bill in the House tomorrow, and that might run this up and might reach to here, and that's gonna be top out. That's what my thesis is. Okay. So let's get back to McDonald. Okay, so McDonald right now, right? So at this point, I think it's gonna reach up here, and then it's gonna go down. Okay, so also another thing here you could do is you could use Fibonacci retracement. Okay, this is from the top down to here. Okay, as you could see, right here is a 50%. So retracement usually reaches 50%. Any weaker retracement would be around 38%. But this one is quite strong, I have to say. I'm kind of impressed. I didn't expect it to go that high to 50%, but it kind of did. Okay. So another thing is, depend on how you draw this. Okay. Some people would draw this right here too, because that that's another peak. Okay. So if you draw right there, right at this point, the 20-day moving average, that's 61%, 62%. So 50% is not a Fibonacci number, just so you know. 61.8 is typically where the point they reach, and I would definitely show that. Okay, so just so you know. So basically, my thesis right now is that it's going to go back down. Okay, after they pass the bill tomorrow, and we'll see what happened over the weekend. We might have some more, like right now New York has so much case which surpassed China now, and then with other stuff. And maybe some other places down, maybe Louisiana or Washington, California, become another hot spot. So that's gonna be make more thing crazy, and drive the market down on Monday. So we'll see. Tomorrow we might top out here, and then we go down. So right now, shorting is something I would like to do. Okay, and depend. Okay, so right now, what would Wall Street do? Right, Wall Street would like, okay, so we're gonna short this. Okay, so instead of buying a straight short, right, close to the money, right, for example, 160. Okay, so right now you're playing a short time frame. You could be maybe just April 17. Okay, 160. Okay, 160 right now would cost you about $8 if you buy that naked straight. Okay, but Wall Street, they're not gonna do that. That's kind of expensive, because 8%, I don't know, let me see, $8 divided by 167, that's nearly 5%. Okay, so that is a decent risk. So what they would do, right, they would do a vertical put. Okay, vertical put, basically okay, I want to show you. Okay, so you buy to open April 17, and you buy at 160. That's where you want to start it. Okay, 160. Okay, and then you're assuming it could go all the way up to 125. Okay, to be honest, it could, to 125. So you sell. You think it's going to go down to here, then you sell, a 125. That would cost you around 490 at this point, compared to just buy a naked put, right? For 160, it would cost you $8. But the thing is, you could play with the vertical put. You don't have to buy 125. You could say, you know what, it might retrace 50% of this around here, so maybe 140 should be a decent price. Okay, so if you buy a 140, okay, it would cost you around a 160 to 140 spread. Okay, it would cost you around $485. Okay, so compared to the other spread, let me see. If you buy a straight one, it would cost you nearly 5%. If you buy this one, let's see, $4.85 divided by 167. So this one will cost you 3%. Okay, so you lower the cost by using the spread. Okay, and so basically you risk around $485 to make maximum gain is $1,515. Okay, so basically that's how much you could possibly gain from that. So with the spread, though, one thing you have to understand is that the time. So even though if it reaches down here and you have a lot of time left, you won't get the maximum amount. Just so you know. Is a little bit confusing, and maybe when I do a spread, I'll do a separate video about spread. I'll link this here, but for now, just so you know, basically you lower the cost by doing the spread of it. Okay, so as you can see here, naked put 160 worth around $8. Okay, and you do a spread, it will cost $485, so nearly 40% off. Okay, and if you know more about this, you could sell a call on top. If you believe it will not go up to certain amount, maybe 170, 80, 190 here, this 190, because right here there is also a resistance here. I don't think it's going to 190. If it does go to 190, I definitely short this thing, definitely. Okay, so if you want, you could do something special. I wouldn't recommend this, but if you want to lower the cost even more, you could add another leg on this option. Okay, so you could like sell to open, and then you could sell a call, right? I believe you could sell a call at maybe 190. Okay, and that would give you $1.28. So that even lower the cost even more here, 3 to 58. So this is something you could do. That's the thing with the spread. There's different strategy that you could play, and lower your cost basic and lower your risk of money. That's how Wall Street people do it. Okay, so typically that's how it is. All right, so I think that is about the Wall Street way. So they utilize the spread. Okay, and then these are their strategy here. So you can take a look at that and search in Investopedia or something. All right, so that's the Wall Street way. And then next thing, I think this is the best way. The get or fall out of the money way is cheap, and it could make you a lot of money. Okay, so it is you buy 4-hour money option. Okay, but the goal is still you want to get into the money. And if there is any problem, and you don't think it's going to reach that point, you could always use a getter spread. So getter spread come hand in hand with this strategy. It's a safety, and it's kind of like cut out, like give you a maximum range, but it like you basically take the profit beforehand. So it's another video I'm probably gonna I'll do separately, and I'll link it here. The getter spread, the way to utilize it. Okay, when I do that, I say so. Just for now, just understand it's a safety strategy. You just you basically take your gain and max and basically minimize your cap your gain. Basically, you take your gain, and then I'm sorry, I just forgot for some reason. But okay, for this strategy, you should know what you should know, right? When you buy a 4-hour option, you want to have some time for it. I usually recommend 1 month, but there are always exceptions, especially like depend on the stock and the current volatility of the market, the general market, and the stock itself, and the event and all that stuff also come into play. So 1 month, I would recommend that. Okay. And then second, you have to understand option pricing. Option pricing is very complicated. It has like 5-6 different variable, and it come into play. But the volatility is one of the most important thing. I couldn't really show it to you, but when we take a look into the option pricing, I'll let you. I'll say something. Okay. But the most important thing right here, I didn't say most important, but you should have access to option charting. Okay, so option charting is very important to determine, to see how cheap the option is in some way. Okay, and then over here, this is, some of you might ask a question, right? Like, if you buy, how far should you buy out of money? According to the time frame wise, I think 1 month, you should do like 7. This is rough estimation. Okay, I don't know much about this, to be honest with you. Just the disclaimer, I'm not a professional. I just learned this right now, and this is what I know, and I do this to show you guys. Maybe it would help, maybe not. I don't know. Okay, I'm being honest here. All right. So basically, if you have a 1 month timeout, 7.5 to 15% should be sufficient. And then 2 months, you could do maybe 10 to 25%, and then 3 months, 20 to 40 or more. Up to you. But there are exceptions here, like how volatile is a stock, and then how volatile is the current market. If the stock a low float stock, if it's a stock is low float, it move a lot. Okay, and then earning in the time frame, and then is there any special event? So all those come into play when you do the time and the percentage. So that's something you have to play out with. Okay, so let's go to example. Okay. Okay, so the getaway, right? For out of money, we all talk about the direction. I'm not going to talk that again. So for this right now, you want to have some time, right? Right now, at this point, to be honest, this current market right now is volatile. I don't think you need a whole month. I think April 17 is an option to play for the short term for this this retracement here after this bounce. I think that is an option to do. Okay, so now you have to find a good price for it. Okay, out of the money, right? Maybe, you know what? Let me just pull more up. So this is April 17. Okay, you want to do quarterly. You don't want to do weekly. You want to do quarterly. So 515, 6 something. Those are more like quarterly. So it's better that way. more people trade them than the weekly. All right, so it's more. Okay, so basically you could look at $100, right? So right now, if you wanna, you depend how much money you have too. Okay, so come into play here. So right now, this would cost about the $100 out of option money would cost you about $47. It could possibly get there. Shit right now is crazy. The market is volatile, and so the stock, right? McDonald's is, people are not going out eating right now. Okay, and I'm not sure people are gonna come out again to eat as often as before. So I mean, at this point, April 17 is a decent timeline. It's not awesome, but it's okay. But at this point, if you have around, $50, you want to spend about $50, this might be in your case. But look at it today, right? Okay, now option pricing, option charting is important. You could see this right now. See, this is option charting. This is today option pricing. So basically, based on this is probably a new chain that they just added on recently, because McDonald's price went lower, so this is recently probably just added. And look at this option. This is the lowest price is today. Okay, and if you look at the daily chart, right, today we barely make a new high. We did not make a new high compared to yesterday, right? However, the option pricing, went all the way down to $35, and yesterday the low was what, $60. Okay, see, option pricing is so weird. Each change is so independent at each other, and it's depend how many people trading them, and then that's affected. It's very weird. So that's why option pricing is different. So the way to best to know this is like have the chart, have the chart pricing. So because yesterday, right, you could see yesterday the price was higher, right? Higher. So the options today we did not go higher than yesterday high. So you expect, the option pricing was still held, right? But yet it went all the way down to $35. So the low was $35. So whoever got in $35 today, and the high of today is $1. Think about that. That's like 300% already within the day itself. So this is a decent option to go with, to choose for. So once you see this, is really good. So let's take a look at 110. See, same thing happened to 110 here. If you have more money to trade, the low is $58. Okay, and the high is only $1. So there is a difference here. This chain itself only give you like 100% gain. Okay, so compared to this chain. See that? So option pricing, each chain is independent and depend how much share are there in that chain, and then the people, how much they want to sell. So in somewhat independent. So that's why I say it's complicated. But once you look at the charting of the option pricing, you could determine this very much easier. And you could look at 120 here. Is when the low is 110. So I mean, if you want to spend $100, this and 120 is definitely in reach, for the daily chart here, 120. So just slightly below that. Okay, so as you can see, with the option charting is very helpful. With this strategy, you get to look at the price, and what people pay for, and then you could play with it. Okay, so that's something I have to say. Okay, so basically that I think about it. Or if you want, right here. Okay, so example, let's go to 515. Okay, so look at the daily chart right now. Last earning was in late January, right? So February, March, April. So late April is going to be earning. So if you buy this chain right here, 515, you actually could play the earning and look at the pricing, right? So 120 pricing right here is $3 something. But the thing is, when their earning come into play, and with this volatile market, you could afford to go out, maybe more than 50% out. So the pricing right here, what's the lowest price? The lowest price is $70 straight. Say the strike is $70. That's the further out you want to go. I mean, you could buy this today for $40. It went as low as $40, and when it has a 90, look at that, the fluctuation. And this change right here was only, the difference was like $1 and 107. So depend on how many people trade this. Okay, The volume, you gotta look at the volume. Here is the IV. For some reason, my thing is broke when they started automatic trading in the New York Stock Exchange. I don't know. I have to call them to fix this. But as you could see here, the more volume it is the the more fluid. And you could look at the 90, the pricing wise, it could determine all this stuff, right? So that's what good when you have the option pricing chart. You could look at this stuff. But like I say, May 15 would cover earnings, so you could go way further out. You don't have to go somewhat, around 100. You could go out down to 70, and make sure, like this is the lowest strike. So if you want to do a ghetto strike, you won't able to do any ghetto strike unless they're going to add new chain into this. Just so you know, if you want to buy, maybe consider 75 or something, some other chain. All right, so just that's something to think about. Okay, so that I think about it for the ghetto fall out of the money way. So you could get to see that, in some way. Okay, last but not least, selling premium for a stable income. This one I'm not going to into depth about this one. It's kind of complicated, but the only thing good about selling premium is that your chance of making money is much higher than buying the option itself. So that's one thing. The only thing is that you use this on something stable. Okay, you don't want to buy when you sell options, you don't want to buy something very volatile. But I know there's some people who do sell option during earning, but that have to be Pacific stock, like stock that doesn't move much. Then you could do that during earning, and you do like Iron Condor. Okay, just so you know, Iron Condor is selling a credit spread on top, and selling a credit call and a credit put. You sell on both sides. I'll show you somewhat on example. Okay, but the one thing I want you to know is that you need to have money to sell option in somewhat depending on what you are selling. Okay, and then the thing is, because you can get exercise on the premium that you sell. Okay, and that would cost you money, and if your account don't have enough, you go into margin and all that stuff, and you have to pay extra money for margin, just so you know. And then some broker charge extra fee for exercising options. So those are things you should know beforehand when you decide to sell premium. Okay, selling premium can be a problem, just so you know. For example, let me show you. You want to do something stable. Usually I would recommend doing an S&P. Okay, you sell an S&P. Okay, let's go to the daily chart. Maybe when it's more stable, around here, you sell something right here and then right here, just like the Bollinger Band. Okay, if you know Bollinger. So you sell that so it won't get into the money. So you sell a credit, a call right here, and you sell a credit put right here. All right, so that's what you do. You sell in between, and the price just move in between, and then it decay the data with time, and then you end up with the money. So basically that's what it is. Okay, a fixed amount of money. Okay, so basically like dividend you get. Okay, so I won't go into depth about it. Maybe I'll do a video about it one day. I'm not really familiar with this. I don't do that often. I usually, if anything, I sell port, like McDonald. I would sell port instead, like maybe Snapchat. I would, like, at $8. If you see my other video, I say $8. I sell port. Look, I sell port right here. I sell port at $8. I sell it. If it go below $8, I don't mind owning the stock. If it go above, then that's fine. But selling port is also an option you could do with selling premium. Especially when it's volatile, when the premium is really high. But I'll maybe do a separate video. This one is just talking about the 3 different strategy. Okay, so basically I guess that is all. I think in conclusion, to wrap this up, I basically recommend you to learn all 3 different way, because you can use them interchange differently in different environment, and you could maneuver yourself way too, because sometimes, you know, when you you can't buy out of the money option all the time. It could get expensive, especially during this time when price keep going down like this. Put option get very expensive. You cannot buy them. It's not worth buying them because you won't make money, you know. So that way, instead, you could just use the credit spread. You could buy credit spread. You could, you know, buy credit spread instead, you know, the Wall Street way. But you don't have to buy close to the money. You could buy further out of money. Okay, as long as your direction is right and your time is right, you could still make money. So that's something you could play. And then, you know, during non-volatile time, you could sell an option, you know, that to make income. So basically, that is about it for this video. All right, so hopefully it's helpful for you guys. All right, and I guess that's it, guys. So stay safe and happy trading. Bye.